The definition of money is the most liquid commodity that exists in an economy. The reason that we call the dollar money is because it stands in for the most liquid commodity, which is gold and silver. And now there's a whole bunch of inflation on top of that. But essentially, when you get down to the nature of what a dollar is, it's a dollar derivative. It's a gold derivative. It's a ticket for a certain amount of dollars. And technically, it's a ticket for $42.22 an ounce of gold. That's what it is. Everything else is inflation on top of that core, right? Dollar isn't a fiat currency in the sense that it's all nothing. It's a little bit of gold with a huge air bubble of inflation on top of it. So when I say I'm holding gold and silver for for good, and I'm not going to trade it I'm not going to sell it. Well, I am going to sell it. There's no point in holding on to gold and silver until I'm dead. And what's the point of that? It's, so what? I may as well hold up the dollars until I'm dead, whether I have a stack of paper in somewhere hidden, or I have a stack of metal somewhere. What's the difference if I don't use it? It doesn't make a difference. So I do plan to sell my gold and silver, except I won't sell it for dollars. That doesn't make any sense. I plan to sell it for stuff, and then take that stuff and, I don't know, build an empire. I'm not going to build an empire. I'm not an empire builder, but whatever. I have certain values, so I'm going to spend my resources in trying to get those values realized in the world. And I think this is my chance to do it. So that's what I'm going to do. I'm going to spend. So, but back 1 second to the definition of money. Money is the most liquid commodity. The most liquid commodity in an economy means the commodity that people want to buy and sell the most of at the same time has the most liquidity, the most buy and sell orders simultaneously. So when I spend gold and silver, I'm selling it. I'm going to sell it, except instead of for derivatives of that same commodity, I'm going to sell it for other things. So I follow mostly the open interest in the gold market. I do pay attention to open interest in the silver market, but because the silver market is much thinner, I think that the open interest are slightly less indicative for that market than gold is for precious metals in general. So if you look at open interest, just means the amount of contracts that are open in the gold market. And right now it's about 400. I think the last I thought was 406,000. So usually they're between, let's say, 450 and 550,000. That's the range that's been in place for 10 years. Sometimes it gets below that. Sometimes it goes above. But the last time we were at about 400,000 was like 2 or 3 times since bear market bottom in 2015, when gold was like $10.45 an ounce, $1,045. So what 400,000 signals to me is that these speculators are mostly gone from the market. Now, it doesn't mean that the volatility is over. Obviously, it's not. And in a market like this, you only need a little bit of open interest to drastically affect the price. Because the more conservative players, like the bullion banks, which are not speculators, right? They go short in the gold market in New York, and they go long in London, and they just profit off the spread. They're not speculating anything. But they don't want to participate in this market so much because, in my view, they see the backwardation in silver. I'm using that word, not how I define it, but how people generally use it. Backwardation is higher spot prices for if you want to buy actual metal than futures price if you want to contract future delivery. So because silver is more expensive in the spot market than it is in the futures market, then that means that you can't hedge your short positions in silver. And bullion banks will see that, and they'll say, look, I don't want to do this right now and short in the futures market and go along in London because I don't know how long that spread is going to be positive, right? It's getting thinner and thinner and thinner, so it's more dangerous to do that even if you're hedging. And I think that's the main reason why a lot of coin shops have shut down, and they're not able to buy constitutional silver anymore from the public, because they'd have to send it to a refiner, and the refiner would have to hedge that inventory in order to ensure a profit for itself, and they can't hedge because the spot price is higher than the futures price. They can't do it, so the refiners can't take it, and therefore the coin shops can't send it to the refiners, so the coin shops can't take it from the public. That's the bottleneck that's happening. So anyway, back to the open interest. if the bullion banks are reluctant in this kind of environment to make a market, that's what they're called, the market makers, to make a market in gold, and it doesn't mean that none of them are, it just means they're doing it less, then price is going to move on a small move in open interest. So the volatility is going to last a little while longer. I don't know how long, but the volatility doesn't mean that there's a huge amount of speculators in the market. There aren't. So my thesis is that while we still might be a little bit away from a bottom in gold in terms of time, I don't think we're far away in terms of price. I don't think we're going to get much farther from where we are now. For gold, I think we're at 4,900 now. I think we're going to float between, let's say, 46 and 52, where we've been bobbing up and down since the mini crash at the end of January. I don't think it's going to change much from that. And as much as we know that everything is messed up, like seriously messed up, still you wake up in the morning, you do your daily stuff, and then, you come back home, you go to sleep, you wake up the next day, it's basically the same, even though you know all this stuff is going on in the background. But eventually that's going to change, right? When it changes, and backwardation in silver it becomes permanent and then moves into gold, and then the prices for spot keep going higher and higher and higher, and the prices for futures keep going lower and lower and lower relative to the spot. Then I'll say, okay, you know what? I think this backwardation is just going to keep getting worse and worse, and that's it. And I think we can batten down the hatches, and I'll sign off and nuke my channel, maybe, I don't know. And then I'll say that's it. But we're not there yet. But when we get there, we'll get there quickly. And I think we're going to get there once we have the next banking crisis, and the Fed has to cut to zero, and you'll see that the Fed funds rate will be slammed to zero by Warsh or whoever's going to be in charge. Kevin, I think his name is Kevin Warsh. And the 10-year yield will not fall like it did in 2020 as sharply. And then the Fed will start to panic and buy and announce that it's buying a whole bunch of 10-year yields to try to push the yield down on those. And then that'll be it. At that point, I'll say, look, guys, this is it. This is your last chance. Do it now or forever hold your dollars. You can frame them on the wall or use them for firewood or whatever. Or, hold your Bitcoin, and I don't know what you could do with that. So we're close because there's only one more step to that. I just don't know when it's going to happen, but I know that it's the next step. And I remember I was just walking into my house and thinking, like, this could happen at any time now. We'll hear of a bank falling over the weekend or something. I mean, that's how the March 2023 regional banking crisis happened. All of a sudden, I woke up in the morning and I saw all these messages saying, Silicon Valley Bank fell. I'm like, what is Silicon Valley Bank? And then I looked at it. I'm like, well, okay, well, something's happening. Well, that's what it's going to be this time. Some bank is going to signal some SOS distress signal, and then other banks are going to say, uh-oh, and then we'll be, okay, well, this is it, guys. It could be any time, but it's going to happen. And when it happens, I'll probably call, that's it, grab your stacks, is your last chance.
I mean, that's just one of it. I mean, they're contracts. The physical markets, frankly, they cannot move as fast as a button push contract. So, while yes, there's a holiday and so maybe buying, but it's not really been the buying of the physical that has been the very big push over all these years. Remember, we're talking about a short-term piece in here, whereas I go back to the long-term steady piece. The other part that is likely unfolding here, along with those other things, is the fact that those contracts, spot silver and gold contracts, were severely overbought, not overvalued. That's a big, huge difference. And I want to talk about that. Because if you look at the contracts on spot gold, now I didn't do it today, so I could be off a little bit. But, it was roughly 39% above that 200-day moving average. Well, 10% is considered a lot. So if you were to go back, for example, and look at a long-term chart on gold, what you would see is this run up and then a consolidation, giving that technical 200-day moving average an opportunity to catch up. If you go longer than that, it's going to be easier. And you see that wedge that was just created too. But yeah, I mean, you can see, I see it twice in that chart that you have up there. Yep, exactly. That's one of those places. So you see they can stay inside of a range. And I think that's also